Hey guys, what is up? It's Arunat here. The last couple days have been quite turbulent as the S&P 500 index is down 2.79% year to date, which is almost 3% for the whole market in just 15 days. And so what I want to do in this video is to highlight and show you some of the connections between the rising inflation rate, the Fed's actions, and the rising interest rates, and what all of that has to do with the declining stock market and how all that is gonna affect us moving forward into 2022. Now, the first half that explains the current situation started last Wednesday when the Bureau of Labor Statistics came out with their CPI data and report. And if you don't know what CPI stands for, it means Consumer Price Index, which is just a basket of everyday goods that a normal household would buy. And so what they do is that they measure the price you would pay for that basket of goods in 1 month, and then they're gonna measure it every month, and they're gonna reflect on how much the price has changed compared to the last month or the last year. And so what the Bureau of Labor Statistics found is that there was a 7% inflation year over year in December. That means you had to pay 7% extra for the exact same products compared to 1 year prior, which is the largest increase in the inflation rate in the US since 1982, and that was 40 years ago. So it's not good. Some items like gasoline is up almost 50% within just a year, and the used car market is up 37%, and various food-related items are up anywhere between 10 to 20%. And so how does it affect companies and the stock market? Just like how the Consumer Price Index shows, when you have inflation, prices are rising. And consequently, a lot of companies had to raise their prices because their own ingredients and components got more expensive as well. And in order to maintain their profit margin, they have to increase their prices. But in the end, it's always the customer who pays the price. But customers and people don't like to pay more and more. And so what some companies would do is to keep the price the same, but reduce what you offer for that price. Just like how Domino's Pizza says it will cut its $7.99 order of wings from 10 to 8 pieces of chicken due to rising food costs. And this is what's known as shrinkflation, keeping the price the same but offering less. And if I had to take a guess, we will see a lot more of these shrinkflation measures going forward in 2022. And the second half that explains the current situation is that the Fed aims to raise interest rates sooner and more frequently than previously planned, and that freaks out the market because once you have inflation, the more you increase interest rates, the more the economy is gonna slow down, and here is why. On one hand, once interest rates start to rise, people with lower risk tolerances will exit their positions in stocks, causing prices to fall because there is less demand for stocks. There are less people who want to hold stocks, as now they can go to hold bonds and put their money in savings accounts because now they have a higher interest rate there, which comes with a lot less risk. And on the other hand, companies are affected in a way that with high interest rates, now it's more expensive to borrow money and use debt. And this environment hurts especially growth and hypergrowth stocks because often they do not have any kind of profit and use debt to fuel their growth. And now that debt is getting more expensive, it's impossible to upkeep the same trajectory for their growth, and therefore people have to lessen their expectations for the future of those companies, meaning that those companies will not generate as much money and the stock price will not appreciate that much. And as some of these people put high expectations into these growth stocks, now some of them will exit their positions, which is gonna make the stock price fall because now it is impossible to live up to those expectations and to the price that would have been justified if the company can keep operating like that. As I mentioned in my previous video, it's fine to buy overvalued companies as long as the environment stays the same. But once the economic environment changes for the worse, the eventual fall of those shareholders holding overpriced companies gonna be that much bigger due to those companies' valuations being inflated compared to how much money they are actually making and other metrics. So what is happening at some of those stocks that have been hyped up in recent months is nothing more than a normalization and coming back towards realistic valuations that are more closely connected to how much money the company is actually making and adjusting their future expectations. So after all, what does the current situation mean for you as a stock investor? If you are someone that is not that experienced with individual stocks, or you are someone that has been buying an ETF like Vanguard's S&P 500 ETF, ticker symbol VOO, keep buying that ETF. You are doing wonderfully. I think that is still the best approach. Keep buying every now and then, dollar cost average down when the market is falling, and your account will do very well in 10, 20, 50 years time. If you have been investing in growth stocks, it might be worth to take a look at some more reasonably priced companies or some large established dividend paying companies, as those tend to do much better in cases of market corrections compared to growth stocks. If you would like to learn how I find companies like that, I'm gonna leave some videos on the side at the end of this video and in the description below. If you found this video valuable, please leave a like and consider subscribing, as it would really help me out. It's completely free and you can always change your mind later. And with that being said, that's it for today. I hope you learned something new today, and as always, thank you guys so much for watching, and until next time.